Well, there's that live look at North American stock markets, and for now we're seeing green. And I'll tell you, we have seen green for a while here, folks, leading equities in the U.S. and Canada to all-time high territory. As some people feel like there's momentum that's just going to continue, is there anything under the hood worth discussing with the bullishness on the rise? And are we getting any messages in particular from the bond market that are worth discussing? Well, Martin Pelletier has been watching that story closely, and he joins us as he often does for a helpful conversation. Good to see you, Martin, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Okay, so let's do the scorecard here. Middle of July, all-time highs for stocks. Anything to pause and think about, in your opinion?
No, we've got a lot of momentum. We've had a nice recovery. Fiscal spending is providing a stimulus to the U.S. economy and flowing up into Canada. Trade concerns have been put to the back burner, which still exist, but not nearly commanding the same kind of attention on the market side. What we're really paying attention to here is longer term and what the bond market is telling us. And bond markets are flashing red. And historically, when that happens, they've been an early warning system for broader financial stress. And that could play out into impacting equities.
Okay. What is it you think the bond market is worried about?
Well, I think we need to look to Japan, for example. They've been historically the quiet stabilizer in what I call a chaotic world. Fast forward to today, and they're no longer the ballast. They're the epicenter of a potential sovereign debt crisis, which is escalating. And what's happening in Tokyo could ripple across the globe, especially into the U.S. Treasury market. Yields are surging in Japan, which is unthinkable. For the longest time, they had near 0% interest rates. And now the 30-year bonds are over 3%, 3.2%, 10 years above 1.5%, 1.6%. And again, that's unthinkable where it was before. And so this isn't really a healthy situation. You've got a yen that's falling near 30-year lows. You've got rising energy costs, inflation, food prices are that much higher year over year in Japan, and a loss of confidence in its central bank. And so they've got to either defend the bond market and have the yen fall further, or defend the yen and have yields spike. And their debt to GDP is over 260%, and 25% of their budgets going towards servicing that debt. And in the U.S., by the way, it's 14%. So there's some lessons of what's happening in Japan that could happen in the U.S.
So when you say all of that, Martin, I wonder if that should be as much a warning to investors about bonds as it is about stocks, right? Like for years, people have talked about things like the 60-40 split, set it, forget it. How do you feel about that kind of portfolio in these times?
Absolutely. The 60-40 had its day in the sun for so long. But this is a different world that we're in. It's a structural shift. You have very large fiscal spending across the globe that can't be financed by debt markets any longer. And so you used to have central banks be able to print money and buy that debt. In the case of the U.S., for example, Japan holds $1.1 trillion of U.S. treasuries and are repatriating capital back. So where's the U.S. going to be able to get capital to fund its deficit, and they're not going to be able to issue debt, or if they do, it's going to be at a high cost. The point I'm saying is that if you look at Japan in the 1990s, Japanese bonds fell 60% relative to gold. And so bonds typically have been a safe haven in regards to equity sell-offs. That's no longer the case, as we witnessed the last couple of years here. And so if you have a 60-40, now may be a good time to start looking at some alternatives on the 40 side at least.
And then, you know, the other thing I'm thinking about is you're saying all of this. Gold has had this incredible run this year. You know, people keep talking about so many of these big macro issues that are building. And even with people piling back into tech, it's not as if they've been unloading their gold at this point. I mean, how do you feel about gold at this point?
I like it, and I've been buying more on every dip. It's a really good way of protecting against policy risks. I'm late to the trade, I admit it. And I think gold's got more upside to go as long as we continue to see this fiscal deficit spending. The U.S. deficit is equivalent to a wartime event or a COVID event as a percentage of GDP, and so they're continuing to spend, and then they're talking about tax cuts at the same time and trying to fund it through tariff revenue. I mean, that's a recipe for disaster, and the bond market is pushing back on that. And then with the way they're responding in the U.S. is maybe we need to get rid of Chairman Powell and take control of the Fed and cut interest rates. Well, what's that going to do to the currency? What that's going to do to the bond market? And so there's a lot of uncertainty there. So having a little bit of gold, at least replacing some of that 40% and taking some of that bond allocation, U.S. Treasuries or Government of Canada bonds, and buying some gold, probably not a bad thing to have in your portfolio.
And then I guess if we're looking for long-term strategy here at a time when people keep talking about the $4 trillion valuation on Nvidia, I'll remind the audience that Berkshire Hathaway is also a $1 trillion club business, and in those scarier moments in the stock market earlier this year, everybody was saying good old Warren Buffett, like he's got the winning hand, but we haven't been talking as much about Berkshire since tech stocks have been rallying again. Should we?
Yeah, well, look at today. I mean, Amex is his top, one of his top holdings, 16% of his portfolio. Chevron's number 5. They've got Bank of America. It's got the bread and butter companies in there that have been able to weather the storm even with market pullbacks. In 2022, don't forget, Berkshire was up 3-4%, while the S&P was off 18%. We manage money for conservative investors, and conservative investors want to protect and grow their wealth, and it's not necessarily about owning the top performing stock. It's about getting to the finish line. And Berkshire's getting to the finish line, sort of like the turtle and the hare, and it's consistent. Its pattern of returns is such that it doesn't get the volatility as the S&P, which is tech heavy. So it's going to get to where you want to get to, but with a lot less variability. So everyone's talking about the recovery from the April lows in the S&P. But Berkshire didn't do that. And sure, Berkshire's been selling off more recently against the rally in the S&P, but this year to date, they're almost equivalent in performance.